It has been a record day for your money. It's been a record year for your money. And if you bought at the 2009 lows, I mean, if you were just that good or listen to Mark Haynes, it's probably been a record decade for your money. But as the saying goes, out with the old, in with the new as we head into the 2020s. Bob Pisani live on the floor of the New York Stock Exchange. I know, Bob, you're listening to that conversation, probably just champing at the bit to jump in.
I am, but you know, it's remarkable what a decade this has been, Brian. It started out with fear, remember that? And it's ending with historic highs. Investors have been absorbed with the search for growth, which is why technology, look at this, so dramatically outperformed everything else, up more than 300% on the decade. Consumer discretionary has done well, healthcare, industrials, consumer staples. But I want to focus on the bottom sectors. There's one notable standout here. Energy, it's the only sector with no gains at all for the last decade. So what is next here? So if history is any guide, investors should avoid the fallacy that the future will look exactly like the past. We've often noted stocks and sectors that outperform one year often underperform the following year. This is called mean reversion. It's the tendency for most investments to revert to long-term averages, and it does happen over long periods of time as well. Let me show you an example. Look at 2000 to 2009. The top three sectors in that decade were energy, consumer staples, and materials. They tended to underperform in the next decade, 2010 to 2019, up only 80%. The three bottom sectors back then, communication services and technology and financials, they tended to outperform in this decade, up 184%. This phenomenon also happened from 1990 to 2000. Technology was the best performer then, and it turned into the worst performer in the following decade. So what is mean reversion? Why does it seem to work as an investment strategy? For the stock market, there's two explanations. First, in a capitalist system, underperforming sectors tend to be ruthlessly restructured until they're more efficient. Secondly, there's that old future fallacy. Humans tend to continue buying things that keep going up in value, creating bubbles that eventually burst. And Brian, of course, that's one of the tenets of the whole idea of what happened in 2008 and the problems we had in that market as well. Back to you.
I remember those days. I'm not sure a lot of other people do, Bob, but you and I remember them. Thank you very much. Bob Pisani, as always, really interesting historical perspective and probably important historical perspective. The question, Victoria, is we're going to ask you a very simple one because you're new to the desk here.
On the spot.
What's the market? S&P target 10 years from now is what? I'm kidding.
Higher. It's higher.
Nice job. Good
I like that. Just
there we go.
Higher.
Good for you.
Okay, how about this? Next year, what do you think? I mean, to Bob's point, people buying in the winter, something we kind of just talked about here. Do you like the setup for 2020?
I do like the setup for 2020, but I think the reason we're looking at, I know he's talking about mean reversion, right? And we've had the techs, the industrials doing really well over the past year, but I think they're set up well for next year also. You've got a central bank that's extremely accommodative. You've got low inflation, right? You've got companies that have been sitting on some cash that are ready to maybe put some of that to work because we've got some of the uncertainties around trade and other issues that are coming off the table just a little bit. So you're setting yourself up to allow some of those cyclical names to continue to do well next year. So I think we won't see mean reversion in the next 12 months.
By the way, Vic, I'm going to jump in because she is in from Houston.
I am.
They have a little oil and gas.
So let's talk about it.
No, but if you believe in mean reversion, that means you're a buyer of oil and gas.
Right. So sorry,
go
please
ahead.
go. All right. So if you think about where the S&P weighting in the energy sector was in 2008, towards the end of that decade, it was almost 17%. It was 16.8% at its peak. It's 4.2% now. So you haven't had to own energy if you're a fund manager. And in fact, you could have avoided a lot of the disasters. But you know, money. You get a lot of cliches after at the end of a decade, at the end of a year. Money is lost very quickly and it's made very slowly. And if you think about the elongated cycles, especially of energy and commodities and emerging markets, we had a period where, first of all, there's always a supply response that comes in the commodity space, whether it's oil, whether it's nickel. I mean, think about where we were at the end of the last decade, and everybody thought we were going to have a shortage of raw materials, et cetera. What happened is not only is there a technical standard deviation, the things that Bob was talking about, but there's a fundamental reason why you get this. They stopped investing in mines. You stopped investing in infrastructure around the energy sector because, in fact, a lot of this stuff was not profitable. And eventually you get to a place where supply and demand even out. I think energy will continue to outperform because I think the companies are being run for equity investors, not growth at all costs. I think emerging markets, which have underperformed for a decade, if we're getting this reflation trade, that's exactly where you're going to see the assets move.
But I'm going to put that in another perspective. perspective, right now, investors are looking for value in their investments. And you're talking about the cheapest sectors and the cheapest areas. That's one of the reasons that you're seeing some of these emerging markets was the redheaded stepchild of
Can't say
everyone's
that.
portfolio.
I got in trouble.
But there's cheap and there's cheap and there's cheap for a reason, Dan.
Well, right, but if you look,
Right?
yeah, there's cheap and cheap for a reason.
A lot of these companies, all they do is use every bit of free cash flow to pay debt service. I don't need to tell you that.
No.